Well, there's been a lot of talk lately about silver looking tired, gold losing steam, and this new Federal Reserve transition somehow breaking the old math for precious metals. So, in this video, we're going to separate the scary chart from the actual setup, and you're going to walk away understanding why the next few trading days matter, but also why one ugly candle does not automatically cancel an entire bull market. Today is Monday, May 4th, New York time. Drop a comment and tell me what day and date you're watching from, because I always like seeing where this audience is tuned in from. And listen, if you value this work, support the channel by subscribing and comment John A.G. Best below. That lets me know you want original research, not recycled noise. So in case you missed what just happened, silver has not really been acting like a dead market. It has been acting like a market that is trying to decide whether the last big breakout was real or whether everyone got too excited too fast. And those are two very different things, because when silver drops a little after a big move, the bears immediately start celebrating. They say, see, there it is, the whole thing was fake. Then the bulls get nervous because miners stop going straight up, silver slips, gold wobbles, and suddenly everybody is trying to interpret a month of noise like it is a final verdict from the market. But that's not how major commodity cycles usually work. A real breakout does not usually happen in a perfectly straight line. It breaks, it pauses, it traps late buyers, it scares early buyers, it runs stops, and then it shows you whether demand is still there. So the question is not, did silver shake people out? Of course it did. The question is, what happened after the shakeout? That is where the story gets interesting. Based on recent market prices, gold has been trading in the mid-4,000 range, and silver has been trading in the mid-70s, with the gold to silver ratio still around the low 60s area. That means silver has already moved, yes, but it is not exactly screaming expensive against gold. In fact, if gold is still in a major monetary bull market, silver can look late rather than finished. Now, I want to be careful here because this is where people get sloppy. A high target is not a thesis. Saying silver can go to some huge number does not make it true. The real thesis has to answer a better question. Why would silver deserve a new pricing range? And there are only a few answers that matter. 1. The monetary backdrop has to remain supportive. 2. Gold has to keep holding the bigger structure. 3. Silver has to keep proving that industrial and investment demand are not disappearing. 4. The old breakout area has to hold instead of turning into a failed move. And 5, miners need to confirm that investors believe the move is bigger than a quick futures market spike. If those pieces come together, then yes, silver can surprise people. But if they don't, then the bulls have to respect the tape. That's the counterpoint. We are not here to blindly cheer. We are here to read the evidence. Now let's talk about the Fed chair part, because this is where the old math starts getting uncomfortable. President Trump formally sent Kevin Warsh's name to the Senate to serve as Federal Reserve Chair, and the Senate Banking Committee has already advanced that nomination to the full Senate. Powell's chair term ends in mid-May, and that transition is not just political theater. It changes how markets think about the reaction function. Notice what I said there, how markets think. A new chair does not automatically mean instant rate cuts. It does not magically make inflation disappear. It does not force silver to explode within a week. But it can change expectations. And precious metals move on expectations long before policy fully shows up in the real economy. That's why the latest Fed meeting matters. The Fed held rates steady in the 3.5 to 3.75 area, but the vote was unusually divided. Some officials wanted less language pointing toward future easing, while one wanted a cut right away. That tells you the central bank is not speaking with one clean voice. It tells you the next chair walks into a room where the fight is already happening. And metals love uncertainty, especially when the uncertainty is about money itself. Now, the bearish side has a point. Energy prices, conflict risk, and sticky inflation can keep the Fed from easing as quickly as silver bulls want. If inflation pressure stays hot, a new chair may not have the freedom people imagine. That's why I don't like the simple version of the story that says new Fed chair equals lower rates equals silver moonshot. That's too clean. Markets are messier than that. The better version is this. If investors start believing the Fed is losing its clean independence, or that policy will lean more political, or that the currency unit keeps getting stretched, then gold gets bid first. And if gold stays bid long enough, silver eventually stops acting sleepy and starts trying to catch up. That catch-up can be violent. And we have to connect this to supply and demand, because silver is not only a monetary metal, it is also an industrial input. The latest industry outlook expects the silver market to stay in deficit again this year, making this a 6th straight annual shortfall. Total supply is expected to rise only slightly, while industrial fabrication is still projected around the hundreds of millions of ounces level, even with some weakness from solar thrifting. Physical investment demand is expected to rebound strongly as investors return to coins and bars. That's important because it cuts both ways. Solar demand is not the one-way rocket some people pretend it is. Higher prices push manufacturers to thrift, substitute, and use less silver where possible. So if somebody tells you silver only goes up because solar demand only goes up, be skeptical. But the opposite is also wrong. Even with photovoltaic demand pressure, other areas like artificial intelligence infrastructure, data centers, automotive electronics, electrification, and investment demand are still keeping the market tight. And when a market is already relying on above-ground inventories to close the gap, price becomes the pressure valve. That's why volatility is not surprising. It is part of the adjustment. Now bring in money supply. Monetary data shows United States M2 is around the $22 to $23 trillion neighborhood. That does not mean silver must reprice tomorrow, but it does mean comparing today's silver price to old nominal peaks without considering the money unit is incomplete. A dollar from decades ago and a dollar today are not the same measuring stick. So when people say silver has already gone far, my question is, far compared with what? Compared with the old chart? Maybe. Compared with gold? Not really. Compared with money supply expansion? Also not really. Compared with the size of the industrial economy that now uses silver in electronics, power systems, and high-efficiency technology? Again, not obviously expensive. And that is why this current congestion zone matters. If silver had ripped higher, failed immediately, collapsed under its old breakout area, and miners started breaking down hard, I would say, okay, the market is warning us. But if silver is instead chopping above the old ceiling, shaking people out, and still being bought on weakness, then the market may be building pressure rather than falling apart. This is where traders make emotional mistakes. They think a strong market should always feel strong. It doesn't. A strong market often feels horrible in the middle because it has to remove weak hands before it can move again. The easy part is the chart after it already ran. The hard part is owning it when the market is making you look foolish for a few days. Now there is another layer here that most people ignore, and it is the inventory psychology. A deficit does not have to mean an empty vault tomorrow. It means the market keeps leaning on old stock to satisfy new demand. That can continue for a while, sometimes longer than bulls expect, but it also means the cushion gets more valuable. The metal that used to be treated as ordinary inventory becomes strategic inventory. That matters because silver buyers are not all the same. A coin buyer can wait, a trader can roll a contract. A manufacturer cannot always wait if the metal is needed for production. So when investment demand returns at the same time industrial users still need supply, the market has to decide who gets the ounces. Usually, price does the deciding. And this is why I don't like analysis that only stares at one chart. The chart is important, but the chart is the final picture of a lot of moving parts. Monetary policy, inventories, mining supply, recycling, industrial demand, exchange rates, investor fear, and political pressure all show up in that one line. If you only stare at the line without understanding what is pushing it, you can misread a shakeout as a breakdown. On the mining side, the same idea applies. A miner can look weak for a few days and still be inside a much larger bullish structure. But if miners keep lagging while silver keeps trying to rally, that is a warning. Miners are supposed to act like leveraged confidence. They do not have to lead every single day, but they should not completely ignore a real silver breakout. So if you're trying to judge this market, don't ask only whether silver is green today. Ask whether the entire complex is improving. Ask whether the miners stabilize. Ask whether silver rebounds faster than it falls. Ask whether gold refuses to break even when the macro news gives it an excuse to do exactly that. And here's the uncomfortable part. The market does not care how badly people want the big move. It only cares whether the conditions are strong enough to force repricing. That means patience matters. It also means discipline matters. If the breakout is real, there will be more than one chance to be involved. If the breakout is failing, hope will not save anyone. So the smart approach is not to worship a target. The smart approach is to map the evidence and update when the evidence changes. Right now, the evidence says silver is still in a high pressure zone. It says the Fed leadership story is adding uncertainty. It says the money supply backdrop is still enormous. It says the physical market is not loose. It says industrial demand has some weak spots, but not enough to make the whole deficit story disappear. And it says gold is still the anchor. That is not a guarantee, but it is enough to stay alert. Because the dangerous moment is usually not when everyone is terrified. The dangerous moment is when the market gets confusing enough that both sides can argue they are right. Bears can point to failed candles. Bulls can point to structural support. And while they argue, the next move starts forming quietly. That is why this week is not about prediction. It is about confirmation, rejection, and whether silver behaves like a market preparing to leave the room and stay flexible too. And that brings us to the next 7 days. No, 7 days is not a magic prophecy window. Nobody serious should act like silver must do one exact thing by one exact date. But after a stop run, after a Fed transition headline, After a divided central bank meeting, after gold holds a high-level range, the next few sessions can reveal whether buyers are still in control. So here's what I would watch. Does silver reclaim strength quickly after dips? Do miners start leading instead of lagging? Does gold hold firm even when yields rise? Does the silver to gold ratio improve quietly while the headlines stay negative? And do sell-offs get extended, or do they get rejected? Those questions matter more than one dramatic price prediction, because if silver is moving into a new reality, it probably will not announce it politely. It will not send everyone an invitation. It will look overbought, then get more overbought. It will pull back just enough to scare people out, then turn higher without them. It will make the bears loud exactly when the bulls need patience. And that is why risk management matters. I know people love the big numbers, low hundreds, mid hundreds. Maybe more if gold keeps grinding higher and silver catches up against gold. But the path matters. A move to a much higher range can still have brutal pullbacks. Miners can underperform during stress. Margin traders can get forced out even if the long-term thesis is right. So don't confuse a bullish outlook with permission to be reckless. If you're successful, share your success story in the comments so others can stay motivated. A lot of people are trying to learn these markets without getting shaken out by every scary headline. Now, could silver eventually trade in the hundreds? In a true monetary repricing cycle? Yes, it is possible. Not guaranteed. Possible. The ingredients would be clear. Gold stays elevated, the dollar narrative weakens, Fed credibility gets questioned, investment demand returns, physical deficits continue, and the old breakout holds. Put those together, and silver does not need fantasy to move sharply. It just needs the market to admit the old range was too low. That is the real point. Not panic, not doom, not cheering for the system to break. You do not need a collapse to have a repricing. You need a functioning market that slowly then suddenly agrees that the previous price was wrong. And if that process is underway, the biggest risk is not volatility. Volatility is the toll. The bigger risk is staring at every pullback, waiting for perfect comfort, and missing the moment when silver stops asking for permission. So keep your eyes on the reaction after weakness. Keep your eyes on gold's structure. Keep your eyes on the Fed transition. Keep your eyes on whether miners confirm. And most importantly, keep your eyes on the difference between a failed breakout and a violent consolidation. Because one of those is a warning. The other is where the next move gets built. And right now, silver has not given a clean final answer. It has given us pressure, noise, disagreement, and a narrow window where the market has to prove itself. That is exactly why the next few sessions matter. This content is for education and market commentary only. It is not personal financial advice, and I'm not telling you what to buy or sell. Use your own judgment, know your risk, and make decisions that fit your situation, not somebody else's excitement.